Hi, and welcome to the Intention Financial Partners Economic and Market Updates for the first quarter or the beginning of 2026. I'm Pat Morris, the Investment Operations Manager at Intention. And normally this presentation we kind of do on a quarterly basis, but now for the second year in a row, we've had a very interesting, volatile, but prosperous April. So we thought we would present more current data to you, and we have stuff that goes through the end of the quarter and then through April 30th. So here's the obligatory disclosure page. So that's that. And joining me is Andrew Abel. And I got to give a round of applause or a shout out to Andrew. He just passed his certified investment management analyst certification. So passed it just a couple of months ago. Very tough test, and Andrew did a great job. So congratulations, Andrew.
Thanks,
So like I said, what we're going to touch on is returns throughout the first quarter, and then kind of what happened in April and it changed them. And then we're going to talk about obviously the Iran conflict, the price of oil, what that means, what it means for the Fed for interest rates. And then also we're going to touch base on one of the things we touched base at the beginning of the year, AI and kind of its impact across other industries, and kind of got one particular industry that it's kind of affecting greatly is software. So with that, I'm going to turn it over to Andrew to discuss returns.
Yeah, thanks, Pat. So what we'll start with here is through the end of the first quarter, so end of March. Quarter one was a relatively flat quarter for us, aside from commodities and real assets. January and February were very strong months. In the month of March, we saw a pretty steep decline, which is why we're around flat for the quarter. So the purpose and the reason behind that was Operation Epic Fury, which was when we, as the United States, started to partake in the Middle East conflict. So this next slide here, also asset class returns, just a bit of a different look. So what I want to focus on here, if you look at the light green line, that is the MSCI Emerging Markets Index. That hit about 15% at its high at the end of February and lost all of its momentum by the end of March, so end of the first quarter. A couple other here, indices that I want to highlight: S&P 500 down 4% end of quarter. The MSCI EFI was down about 1%. Russell 2000 up about 1%, and the ag was relatively flat. So what we'll dig into now is returns through the end of April. First, we'll go over domestic equities. So as a whole, equity indices had a nice bounce back in the month of April. I know there's a lot of numbers on this slide, so what I'd like to focus on is the graph on the bottom here, which is the S&P 500 sector returns. So S&P 500 for the month of April was up about 10.5%. So that puts it at about 5.5 to 6% year to date. So very nice bounce back in the month of April. Couple other sectors that I want to take a look at here. IT and communication services, very strong as well. So definitely some good numbers there throughout the month of April. Lastly here, we'll touch base on international and emerging performance. Again, lots of numbers here, so I'll try to break it down for you. But the MSCI EFI, like I said, was down about 1% through the first quarter. By the end of April, it was back up around 6, so very solid returns throughout the month of April there. Same goes for emerging markets. Like I mentioned, by the end of the first quarter, relatively flat. By the end of April, back up around 14.5%. So a very nice bounce back for emerging markets as well. With that, I'll let Pat take over here to talk about some PE ratios in detail.
Yeah, thanks, Andrew. Yeah, it was a second year in a row, like we said, an incredible April, and it's really amazing how it bounced back. So one of the things that we talked about at the beginning of the year was, investing in a fully valued or an extended multiple index. And the example that we were using is the S&P 500. It's had 3 great years, led by, obviously the Magnificent Seven and this AI boom. And while we think it was a great happening. It was interesting to see what would happen if other stocks took leadership. And we've seen some of that. This growth has not been all about the Magnificent Seven. And one of the things that when we came into the year, we were talking about the valuations, and the PE ratio on the S&P 500 was at 22 times, which is above one standard deviation above its normal. And its norm is about 17 for the 20-year average. So, but we've seen that drop down. Like 1 month ago, it was at 20, and now it's at 21. So by no means is this a cheap market. Valuations are still slightly extended, but we're seeing this, and the good news in this is that why is this happening? Well, we're seeing what's called multiple compression, and that basically means the E, or the denominator, is growing faster than the P, right? So Andrew showed we're up 5% now for the year, or 5 to 6%. Well, the earnings have been about 11% year to date. So you're seeing earnings grow faster than price. You don't always want to see that, but in this case, it kind of lets the multiple, we'll say, catch up. And on the bottom, you see the Russell 2000, and I apologize for this graph because the time during COVID kind of throws the skew out of whack a little bit. But last year, at the end of last year, the PE on the Russell 2000 was 23.3, and now it's at 25. So it's all right within its normal average. PE on the Russell 2000 is a little hard to gauge because it does include 2,000 companies. A fair amount of them are not making money yet, so it's kind of hard for a PE when you have a negative E. So, but we can say the same about international developed. At the end of last year, it was at 15.5 times, and now it's at about 15 times because we're seeing growth in earnings across the board, across the globe. And you might say, well, why is this 15 and the US is 20? Does this mean it's cheaper? Well, no, we have to look at things on a relative basis. International developed has a lot more financials. As you see down there, 25% of the companies are financials and 20% are industrials. So kind of mature businesses, if you will, stuff that's not growing as fast as, well, you'll say like information technology or communication services or some of the stuff in the US and the S&P 500. But, like I said, you've seen great returns here. The 20-year average is about 14%. So it's higher than it was a year ago, but that's to be expected. We saw an incredible year. One of the reasons why we preach diversity, you've seen an incredible year in emerging markets and returns in emerging markets and international developed. And speaking of emerging markets, as you can see here, it's right around its 10 or 20-year average. And you might say, well, how is that possible? We just talked about you having 14% return. Well, the emerging markets might be up 14% this year, but they're looking for 17 to 20% earnings growth. So there again, you have the E is growing slightly faster than the P in the PE ratio. So at the end of last year, it was at 13.3, and right now it's at 11.6. So, I still think international developed emerging markets play a key aspect in any portfolio. And we've showed many charts over the years about how when it comes into favor, it's into favor for a while. So, and just real quickly at the bottom, you can see some of the industries that did well. Obviously, IT did very well. Industrials, IT big in Taiwan and Korea. And then, we saw a lot of growth in energy and materials in countries like Brazil and Mexico. So, was April volatile? Yes, it was. And, but the two indices we kind of look at here is the VIX. So this is the one in the dark blue. It's run by the CBO, the Chicago Board of Options Exchange, and it's sometimes called the fear index. So it's kind of when this goes higher, people are fearful of the industry or the sector or market dropping. And then its cousin is Move, which is the fixed income portion or the bond portion. So are they both higher at the end of April? Yes, they're higher than they were. As you see, kind of, you can point out where they were at the beginning of 2025 or the beginning of 2026. They're higher, but within reason, right? I mean, you look back, there's some points during 2024, 2025 where they were higher. Obviously, COVID, they were higher. And throughout times, they've been higher. So it's happening in an orderly fashion. And one of the reasons we believe this to be true is people know where the risk is, right? The risk is on because of what's going on in Iran and with the price of oil. So it's a known, I guess, known risk rather than something unknown. So with that, speaking of oil, I'm going to turn it back over to Andrew, and he's going to have some interesting stuff.
Thanks, Pat. Yeah, so throughout the years, there's been a perception that the Middle East is a big partner in sourcing our oil imports. So what this slide is covering, it's data that was taken from a survey that was done in 2025. So the bar graph that you see right now on the left here shows that the individuals who completed the survey believe that 53% of our oil imports came from Saudi Arabia and 22% came from Canada. However, if we take a look at the graph on the right-hand side, this shows the reality of where our oil imports are coming from. So we're actually receiving about 62% of our oil imports from Canada and 10% from Mexico, with only about 4% coming from Saudi Arabia. So a big difference from the perception. One other thing I'd like to cover that's not on this slide is the Strait of Hormuz. I know that's a big topic of discussion right now, and all I really want to say about this is a lot of the oil that is heading through the Strait of Hormuz is headed east, so it's headed towards China, India, South Korea, and not as much going west towards the United States per se. So next, what I'd like to cover, this is pricing of oil markets. So we're going to take a look at front month futures versus 12-month futures. So that's what these graphs are showing us. If we take a look at the right side, that's the one I'm going to focus on here. The yellow line is first month Brent crude futures, and the dark blue line is the 12-month Brent crude future. So what we're seeing here, there's a large surge in short-term oil prices, which has been caused by the supply issue we're seeing from the Strait of Hormuz disruption. The 12-month future, which is that dark blue line, like I said, it's lower, which is telling us that the markets have an expectation that there will be some sort of a resolution within the next 12 months or so. This also is supportive of what Pat discussed previously regarding volatility. So markets are knowing where the source of volatility is coming from rather than an unknown source. Now, what I'd like to cover, we call this the economic surprise index, just to give you an idea of what this is, what it means. So you see line at zero here. When it's above zero, when the graph is above zero, it means that the reported or released or official economic data is beating what economists forecasted. So what we can see here is that that line has been above zero since the end of summer, early fall timeframe of last year, and it's also near its highest level since about October of 2023. So this is in part due to the AI developments we've seen here, and then also U.S. consumer strength, amongst other things. Speaking of U.S. consumer strength, this graph, what it's showing us is year-over-year growth of real PCE and retail sales. What we can see here, aside from the COVID era, as well as a few months throughout 2022 and 2023, retail sales have been positive. It's also telling us that consumers are continuing to spend money despite cooling labor market conditions. Now, I know this graph. There's a lot going on here, and I apologize. I know it's difficult to read, but a couple things I'll try to break it down for you. So let's first take a look at that red line, which is the Iranian conflict. What we're able to observe is that it is following or on track with some of these other geopolitical events that are listed. But really, what I want everyone to focus on is the far right side of the graph, which is 400 trading days out. there's a much wider range of outcomes here. So at this stage, market performance tends to shift away from the geopolitical event itself and back toward economic and corporate fundamentals. So future performance is ultimately driven by factors such as business momentum, economic growth or decline, earning strength, et cetera. So items like that. The key point of this graph, again, like I said, I know it's a little bit confusing and difficult, but what we want you to take away from this is that you have to look beyond the geopolitical conflict, which Pat and I did discuss during a previous webinar a few months ago. So if you'd like to look into that a little bit more, I'd say go take a look at that one as well. Last slide I'm going to cover today. This is highlighting how expectations for the Federal Reserve rate cuts have shifted throughout this year. So what we can see at the beginning of 2026, there was an expectation that there would be around 2 rate cuts, give or take, for the year. However, now we're seeing expectations have moved lower with a projection of honestly about 0, give or take, between 0 and 1. So again, it's kind of fluctuating here and there based on data that's continuing to come out. And speaking of some data that's recently come out, the most recent CPI report, we saw an increase in inflation. So all of this puts the Fed in an interesting situation and spot as they're trying to control price volatility and support full employment at the same time.
Great. Thanks. Thanks, Andrew. And one of those things that it brings up is we talked about volatility, and people start hearing about volatility, and people hear about inflation, and they mean what does that mean for my bond portfolio? And they start thinking of 2022, and oh no, is this what's going to happen again? And we don't think so. So what we have here is kind of an interesting graph, and I'll take it through you. Uh, take it take it down piece by piece for you. Right now, the Bloomberg Aggregate Bond Index roughly has a yield of somewhere between 4.5 and 4.75%. So that's the middle line there. You see unchanged, and it's 4.66%. What that means is basically if the interest rates didn't change at all, you'd be getting a 4.66% yield on your money. If you go to the far right and into that brown area, it's 25 or 0.25%, 0.5%, and 1% rise in rates. Now, that doesn't mean what the Fed would raise the rates. That just means what the market would do. The Fed controls the short end of the market. Market participants viewing inflation, et cetera, would control the back half of it. So it's a combination of the two. And that brown shows you, let's take the worst case or an example of 100 basis points, which is 1%. Well, a 1% upward movement in rates would cause the price of the bonds to fall about 6%. So the 6% decrease, and you'd have a 4.7% yield, would get you about a negative 1.3% return. Not great, but by no means doom. And if you go the other way and you got a 1% decrease in rates and the 4.7% yield, you'd be looking at about a 10.7% return, which is not that dissimilar to what we had last year. We were in about the 7, 8, 9% range for some bond funds because we did see, the interest rate or the yield plus a little bit of price improvement. So where do we think it'll happen? Probably somewhere around the unchanged 25 or 0.25% either way. So that's kind of what we anticipate for bonds this year. So one of the other things that has come up and is AI. When we talked at the beginning of the year, for the last couple of years, it's been AI. Who's the leader in providing AI content, AI, the chips for AI, everything kind of revolving around AI. And then while that's very, very important, one of the things we talked about was how AI was going to impact the market or impact other industries or other sectors. And we thought that these smaller sectors, smaller industries somewhere along the S&P 5, or excuse me, the S&P 600 or the Russell 2000, some of the smaller companies would benefit from the processing and benefit from the efficiencies. And so far, we've seen that to be true. Now, here's an example of something called a soft apocalypse, which I'm glad I got that out. I didn't think I would be able to. And it's the AI effect. So basically, what this chart shows is the bottom line is the S&P 500 and the PE on the S&P 500. And the dark blue line is the PE on the software industry. So it normally trades at about a 50% premium to the S&P 500. So if the S&P 500, as we looked at before, trades at 20 or 22 times, the software PEs were trading at 35, so 50% premium. That's all been kind of taken away over the last 3 or 4, or maybe say 6 months. And that's because, AI, OpenAI and its competitors have basically come out saying we're going to redo the model for every industry sector across the world. And the software was the first industry that kind of felt the brunt of that. And so you could see what it means. Now, does this mean it's the end of the software? No, I think it means it's just shifting. There's been data points that have pointed out that there are more people looking for software engineers and software developers than a year ago. So that number is improving, but I think it just goes to show you the shift that AI is having on particular industries. Now, this probably won't be the last one we see of it. And some of it, like we said, we've seen in the S&P 600, Russell 2000, some of the smaller industry, the small cap industries or sectors that is really profited from it. So, in conclusion, the Iran war, brought uncertainty to the market, and it's been volatile. But we saw a bounce back in April, and it seems like you got to look beyond it and compare it to relative time in history because profits still remain at an all-time near highs. Like we said, we're seeing growth in earnings that were bigger than the growth in price. So that's always a good thing. Interest rate volatility is picking up, and the bond market reacts to all the news about, the inflation pressures and then, what the Fed is going to do. It's kind of a mixed combination. But right now, we believe that your coupon payments, which your interest rate or your yield, is providing some buffer to that. And so we believe that, there's going to be considerable political pressure to likely push the conflict towards the end over the coming months. Nobody, I think, wants this war to go on, and nobody definitely wants, from a political standpoint, wants to see it go on coming closer to the midterms. So, as always, we appreciate your time. We try to build these portfolios that are durable, so that's why you see that we have not only different types of fixed income, but equity. We have international equity. We have diverse or developed markets. We have emerging markets to build a robust portfolio for your needs. But as always, if you have any questions, feel free to reach out to your advisor or Andrew or I. And again, we thank you very much for your time. Thanks.
Thanks, everyone.